So we will now transfer all of these amounts there. Before that, since we don't have anything under schedule 15, that is miscellaneous expenditure, but as a sort of a format requirement, we will just mention it there as nil. Okay, miscellaneous expenditure nil. You don't have to write any figures under this. So all of these amounts now, as per the schedules and as per the proper format of the balance sheet, we will transfer these to the actual balance sheet. Okay. The investment reserve we will calculate as we come to that particular category. Okay. So this is the balance sheet now of Southern Insurance Company, and first we have the sources of funds starting with schedule number 5. Okay, so schedule 5, you have to write the schedule numbers correctly. We have share capital, amount is 2000. Whatever you have highlighted in the outer column, all these amounts, take them up to the balance sheet now. Okay, next, reserves and surpluses. I'll go a little fast here since we have already done the calculations and now is this posting. Total of reserves and surpluses is 1900. Okay, 1900. Next, you have borrowings. Amount, schedule number 7, amount of borrowings is 3000. Correct. Then you have in sources of funds, we have another item. Now this is where the investment reserve calculation will come into picture. There is fair value change account. Now what does this mean? We have something called the fair value of assets or any investment that we hold in our business. Okay. Now what does this fair value mean? It means that at any point of time, if you try to sell your investments or you try to sell your assets in the market, what will be the value that you will get for it? Okay, like if you try to sell a particular, so if you try to sell a particular asset or any investment that you're holding for to another party at any given point of time, all right, what will be the price that you will get, the value that you will get for such an asset? That is called the fair value, right? Most of the times the market value becomes the fair value. Okay, but it is actually the amount of money that this other party is willing to pay you for your assets or your investment. Okay, so for calculating this fair value change account, okay, the value that we are going to write here, we are going to prepare a small working note. Now what we've done so far is schedules. Okay, do not confuse schedules with working notes. Fine. So we're going to do a working note for the fair value change account. Done. Now let's just do a small table. I'll do it in table form because it becomes easier. You don't necessarily have to, you can just write the particulars and the amounts next to them. Okay, so let's see. Now, which are the different investments that are given in this problem? Okay, see, this is investment reserve. You have to look at what information is provided and why are we calculating this fair value change or changes in the fair value. You have investment reserve of 200 given to you. Okay, and of course then there are investments, different types of investments. Okay, so in this case we have been given investment reserve. Like I said, we have been given what is the market value of the investment at the end of the year, and we've also been told which are the types of investment, the book value of those investments as it shows in our balance sheet. This is what we have been maintaining as per our books of accounts. Okay, now you first have to take those investments, take the value of the investments as shown in the books of accounts. Okay, so investments in government securities, amount is 2400. Okay, so 2400. Then what other investments do you have? Shares and debentures of JSC 1500. Take all the investments that you have, all types of investments that you have, and add them up first. Add the values of those investments. Okay, shares and debentures of JSC 1500. Got it? Now total this up and you get your total investment. 2400 plus 1500 gives you 3900. Done? Okay. Now this is your value, meaning the value at which you have recorded these investments in your books of accounts. According to you, this is the value of your investment. Okay. Now this value may be different from the actual market value that is going on of those investments, right? Because in the market, as in on the stock exchanges, these securities, these shares and debentures may have a different value based on the demand and supply, but in your books it is showing at 3900. So from this 3900, that is your value minus the market value of the investments, you will get a difference. All right, you will get a difference as to how much you have shown compared to how much is the actual market value. So what is the market value given? 36 lakhs. So this will be, all these amounts are in thousands. Okay, I think it's not clearly mentioned in the problem, but all these amounts are in thousands. Okay, so this will be 3600. Correct? If you reduce it, this is 3600. That means market value is a little less than the value you have shown in your books of account. And what is the difference? What is the change? It is 300. Is this clear? So difference between recorded value and the market value is 300. Now what to do? You have maintained a reserve, you have maintained an investment reserve of 200. Okay, the balance right now of this reserve is 200. So what happens is, whenever you realize there is a change in the value of the investments, the fair value of the investments which you have made, you need to adjust it with that investment reserve which you had made. Okay, so what is this investment reserve? It's like a provision. How we keep provision for bad debts? You know you're going to suffer a loss. You know there will be, some people, some debtors who will not pay, and you will end up having bad debts, right? So we firstly make a provision for bad debts, isn't it? So that even if such loss is incurred, that loss is, sort of taken care of by the provision. It is already recorded, or it is already anticipated in the form of that provision. Same way an investment reserve is made. It's like a provision. Okay, so minus this provision from this investment reserve, all right, and you will have the balance, which is the amount of the fair value change. Okay, so that means the fair value of your investment has changed to this much. Correct? This is the amount of the loss. You have suffered not exactly a loss, but then your investment has reduced by 300, isn't it? You think it was 3,900, but actually in the market it became 3,600. So it reduced by 300,000. But then you've already prepared for a little loss in the form of this investment reserve. Fine? Correct? So what happens here? Minus this investment reserve from this loss that you have suffered, and you get the balance of the fair value change, right? The remaining loss that you are still supposed to record. So this goes in the fair value change account. There is no scheduled number to this, okay, right? And this fair value, always write it as a negative over there. Okay, so negative or minus 100, all right, and then you can total up. It's just like how we write reserves, changes in reserves, right? In the revenue account, if you'll remember, changes in the unexpired risks or changes in the reserves, we find out the amount and that amount is written as a negative. It is deducted from the incomes. Same way here also, and then you can just total up the whole thing. 2000, 1900, 3000, and you get 6800. So what exactly is this total? This is the total of your sources of funds. Alright, so we have total of the sources of funds. Basically how we have total of liabilities. In common balance sheet, the first total is the total of all your liabilities. Okay, now let's see. Next we have application of funds. Sources is done. We are going to record the application of funds now. Okay, so going back to all your schedules, up to schedule 7 is recorded. Now start with schedule 8 and you have investments. You first record all your what do you say, fixed assets or investments and fixed assets type of assets. Alright, application of funds. So investments, schedule 8, we have not recorded it over here yet, the fair value change. So just write it here first. We have done this calculation for fair value account, isn't it? So this same calculation we are going to show over here also. Okay, so under schedule 8 investments, we had just left this aside. So what have we done here? The same thing you have to carry forward it here, the same calculation. Okay, get the total 3900, alright, and from this total you deduct market value or the fair value account. Less market value. You just have to show it here because the total value of the investments has now changed, isn't it? So you have to show that difference. Okay, so less, sorry, not market value, you have to show the change, less change in value, which is 300. That means your investment has reduced by 300. It's like how we show depreciation, fixed assets less depreciation. Same way, how much reduction has happened in the value of your investment. And in the outer column, actual value of the investment has now become 3600, isn't it, as per the market value. So this you have to do a reconciliation. This 3900 has now become 3600. Alright, so back to the account here, the balance sheet, and you have 3600 for schedule 8. Okay, next schedule 9 is loans. Amount is 2000. Right, if you go on entering the values now. Then next one, schedule 10 is fixed assets. These are all the fixed assets and the long term type of assets that we have over here. Okay, schedule 10, value 1500. Next one, what else do you have? So schedule 11 is cash and bank balances. Now this falls under the category of your current assets, alright, not the fixed assets, not the long term assets. So we will write them a little separately. So we will first take a total of this. There are subtotals to the asset side. Okay, so take a total of this, and this will be 7100. So we'll just leave this aside, 7100. Now next let's record current assets. Okay, these are total fixed assets. Next we will record current assets. I'll just make subcategories. Okay, for current assets and current liabilities. This format that is given here is slightly different. We have to write current assets separately. In fact, it's given, it's just not underlined or highlighted. Current assets are separate and then they have their own total. Current liabilities are separate and they have their own total. Okay, so let's see. For current assets, what do we have? Cash and bank balances, schedule 11. Amount 3,600. Then advances and other assets, schedule 12. Amount is 450. Okay, any other current assets? Then is current liabilities. So current assets end here with schedule 11 and 12. Okay, so get the subtotal. We'll call this the subtotal. Okay, and the bracket A. Just for later calculations it becomes simpler because we want the net current assets, right? These are all long-term assets. Okay, and these are current assets and current liabilities. So what is the total of this? After adding up the two, you get 4,050. Am I right? Now, same way, just like you have calculated current assets, also calculate current liabilities, right? So we're doing this separately. We're making two different classifications for these. Okay. So under current liabilities, what do you have? Schedule 13, current liabilities itself. Amount is, total is 1,350. Then you also have provisions, right? Miscellaneous expenditure, there is nothing, but there are provisions. Schedule 14 and the amount is 3,000, right? This amount 3,000. Okay, so that was your two current liabilities. Again, underline schedule 15, we don't have anything. You may just write it actually, although it's not, no other amount is given, but just for the sake of those schedules. 15 nil. Okay, so if you total all these up, again you get another subtotal only for current liabilities, right? So 4,350. Okay, now what happens? So this is your subtotal. Just underline these. Just doing different categories. So this is your subtotal. 4,350. Now what do? We have current assets and we have current liabilities, okay, and we've also calculated these long-term assets, investments, loans, fixed assets. So what do we have to do is first calculate net current assets. What are net current assets? Current assets minus current liabilities, you get the current assets. This is clear? So it's nothing but A minus B. A is subtotal of current assets, B is subtotal of current liabilities. So how much do you get? 4,350 minus 4,050, meaning the other way round. 4050 minus 4350, you will get, just write it below one line, you will get a negative 300. Correct? Current assets minus current liabilities. A negative basically tells you that your current liabilities are more than your current assets. Okay? So how do we get the total of the asset side? This is the total of the liability side, isn't it? 6800. And for a balance sheet to tally, the total of this assets side should also be, there is a sources of funds side should also be 6800. And how do we get that? Total. Now this total will be application of funds, this long-term investments total, that is 7100. I just write the amount itself over here, 7100 minus this 300. Now why minus? Because it is negative. If it was positive, we would be adding it up, correct? We would be doing this long-term assets plus the net current assets. But this is negative, so this will be written here as minus. 7000 minus 300 actually gives us 6800. Okay, and this is the same as your balance sheet total of the application of funds. So this and this is supposed to match. Total of sources of funds, total of application of funds. Is this clear to you? Between that, these are subtotals only for the purpose of calculation of net current assets. Current assets minus current liabilities. Okay. So that was our balance sheet problem on under insurance companies. Okay. And these are the different schedules that we have under it.